Objectives. At the end of the lecture, you must be able to explain spontaneous financing versus negotiated financing. 2. Explain the various types of spontaneous and negotiated financing. Accounts payable and accruals. Unsecured and unsecured loans. Analyze and compare the effective interest costs for different types of financing. Lecture outline. Introduction, spontaneous financing, accounts payable, accruals, negotiated financing, unsecured financing, line of credit, discounted loan, secured financing, accounts receivable financing, factoring accounts receivable, inventory financing. Financing costs, stated interest rate, effective interest rate. Introduction. What is the advantage of borrowing to invest? If the return from an investment exceeds the cost of borrowing to finance that investment will increase a firm's profit. What is meant by short-term financing? Borrowings to meet the financial needs of a business within 1 year. The two sources of short-term financing are spontaneous source and negotiated source. Under current liabilities, you have accounts payable, basically borrowings from suppliers, accruals, borrowing from external parties, and negotiated short-term loans, borrowings from banks. The first two are spontaneous financing, and the bank loan is negotiated financing. Accounts payable, generating by buying supplies and paying at a later date. So this is basically buy on credit. There's no explicit interest cost charged, but is it really free interest loans? Question. If you are a supplier who sells on credit, what credit terms may you include? Credit terms. Cash discount, in short CD. Percentage discount for early payment within a stated time period. Discount period, DP. A period for which discounts apply. Basically, there's a period of time the discount is valid. After that discount expires, no more discount. Credit period, CP. Period between start and date by which full payment must be made. Beginning of credit period. Usually date of invoice, the date of billing for goods received. There's an annualized percentage cost of giving out cash discount. So formula is this: CD divided by 100% minus CD times 36 divided by CP minus DP. Again, CD is cash discount, CP credit period, discount period. CD is interest paid. 100% minus CD is basically the amount of payment if discount is taken. CD minus DP is basically number of days payment is delayed until the end of CP. Accounts payable. Generating by buying supplies and paying at a later date. So this is basically buy on credit. There's no explicit interest cost charged. But is it really interest free interest loans? Question. If you are a supplier who sells on credit, what credit terms may you include? Unsecured financing. The line of credit or overdraft. Bank gives you a credit line limit. Normally it's tied to a current or checkbook account. Interest is charged on loan amount loan out. You borrow, we pay back the bank, and you borrow again and repeat. You can borrow up to maximum amount of the credit line given by the bank. So as long as you keep within, for example, if the bank give you 10,000, as long as you keep within that limit, it's okay. You can borrow, repay back, and reborrow. So the limit is reusable. There's not guaranteed loan. Bank may cancel the loan anytime. Discounted loan. Interest is paid upfront. Interest is deducted from the loan at the start. So borrower receives less than the amount actually borrowed. Secured financing is secured by some form of assets. One is accounts receivable financing. This pledging of accounts receivable to the bank. So bank will provide loan based on a certain percentage of the accounts receivable pledged. So the firm here sells some goods to the customer, and the customer in turn owes the firm and becomes accounts receivable. The firm wants to borrow money from a bank and pledge the accounts receivable to get the bank loan. Factoring accounts receivable. Selling accounts receivable to lenders at a discount, usually under notification basis. For example, customer is notified to pay directly to the factor bank. Non-recourse basis means the buyer of the account receivable bear the credit risk. So cannot claim losses if the bank cannot claim losses from the borrower if the customer fails to pay. This is a formula for finding stated interest rate. The answer is in percentage. And the other one is interest payable in terms of dollars. Take note there are some difference between them. In the formula, please do not mix them up. So principal borrowed 50,000, usable fund 50,000. Stated interest 8%, effective interest 8%. The stated interest rate and the effective interest rate are the same, 8% both, because the usable fund is the same as the amount borrowed. The effective interest rate is 8.69%, which is higher than the stated interest rate of 8%. In this case, the effective interest rate on a discounted loan is higher than the stated interest rate, because the borrower must pay interest on the full loan amount but receives an amount less than the principal borrowed.